If you live in Los Angeles and you are earning a good income, whether through business, real estate, or investments, there is one reality you already know. Taxes are high, and not just slightly high. Between federal taxes and California state taxes, a large portion of your income can disappear before you even have the chance to reinvest it. So let me ask you something. Are you just accepting that reality, or are you actively managing it? Because the difference between those two approaches is not small. It is often the difference between building long-term wealth and constantly feeling like you are working hard but not moving forward financially. Most people in Los Angeles focus on earning more, and that makes sense. But high earners who actually build wealth focus on something else as well. They focus on how much they keep. In this video, I want to walk you through how smart individuals in Los Angeles approach tax planning, not as a once-a-year task, but as an ongoing strategy that supports long-term financial growth. Let's start with a simple but powerful idea. Tax planning is not about avoiding taxes. It is about controlling timing, structure, and efficiency. Because once income is earned, the way it flows, the way it is categorized, and the way it is reinvested all affect how much tax you ultimately pay. Now, let's begin with something foundational: your income structure. In Los Angeles, many high earners have multiple sources of income: business income, W-2 income, real estate income, investment gains. Each type of income is taxed differently, and without planning, these income streams can stack in a way that pushes you into higher tax brackets without any coordination. Smart tax planning looks at how income flows together. It asks whether certain income can be shifted, deferred, or structured differently to reduce overall tax impact. Now moving forward, let's talk about entity structure. If you are running a business, the way your entity is set up matters more than most people realize. Are you operating as a sole proprietor, an LLC, an S corporation? Each structure has different implications for self-employment tax, payroll tax, and income distribution. As income increases, what worked at a lower level may no longer be efficient. This is why experienced tax advisors regularly review entity structure as part of long-term planning. Not to complicate things, but to align structure with income levels and growth goals. Now let's shift into timing, because this is where a lot of planning opportunities exist. One of the advantages of being a business owner or investor is flexibility. You may have some control over when income is recognized and when expenses are incurred. For example, accelerating certain expenses before year-end can reduce taxable income in the current year. In other cases, deferring income to a future year might make sense depending on projected earnings. But timing decisions should not be random. They should be based on projections. Smart planning involves reviewing your numbers before the year ends and making adjustments while there is still time to act. Now let's talk about something that plays a major role in long-term wealth building: reinvestment strategy. Many people focus only on reducing taxes today, but smart investors think beyond that. They ask, where should this capital go next? Real estate, for example, can provide both income and tax advantages through depreciation. Retirement accounts can provide tax deferral while building future security. Business reinvestment can generate additional revenue streams. Tax planning is not just about reducing what you owe. It is about directing your after-tax income into assets that continue to grow. Now, moving into something that often gets overlooked: coordination. In Los Angeles, high-income individuals often work with multiple advisors: a CPA, a financial advisor, sometimes an attorney. But if these professionals are not aligned, planning becomes fragmented. One advisor focuses on investments, another focuses on compliance, another focuses on legal structure, and no one is looking at the full picture. Effective tax planning requires coordination. Decisions about investments, business structure, and income timing should work together, not independently. Now, let's talk about something that becomes more important as income increases: state tax exposure. California has one of the highest state tax burdens in the country. For individuals with significant income, state taxes alone can have a major impact. This is why planning in Los Angeles often includes evaluating residency, the sourcing of income, and how different activities are taxed at the state level. Ignoring state-level strategy can leave a large amount of money on the table. Now, let's move into another key area: consistency. Tax planning is not something you do once and forget. Income changes, markets change, business conditions change. Your strategy should evolve as well. Smart individuals review their tax position regularly. Mid-year reviews, year-end planning sessions, ongoing adjustments. This creates predictability. Instead of being surprised at tax time, you already understand what to expect. Now, let's address a common misconception. Some people think tax planning is only for very high-income individuals. That is not true. The moment your income becomes meaningful, planning becomes valuable. Because even small improvements in tax efficiency, when repeated year after year, create a significant long-term impact. And in a high-tax environment like Los Angeles, those improvements matter even more. Now, let's bring everything together. Smart tax planning in Los Angeles is built on a few key principles. Understanding how your income is structured, choosing the right entity for your business, managing the timing of income and expenses, reinvesting strategically, coordinating across advisors, and reviewing your plan regularly. When these elements are aligned, taxes become manageable. And more importantly, your financial growth becomes intentional. Because wealth is not just built by earning more, it is built by keeping more and deploying it effectively. If you are earning income in Los Angeles and you feel like your tax strategy is reactive instead of proactive, it may be time to rethink your approach. Not because something is wrong today, but because better planning today creates better outcomes tomorrow. If this video helped you see tax planning from a different perspective, subscribe to our channel. We share weekly insights designed for business owners and investors who want more control, more clarity, and stronger long-term financial results. And if you want to explore smart tax planning strategies tailored for Los Angeles, visit gavtax.com to learn how proactive planning can help you reduce taxes and build long-term wealth. Thank you for watching, and I will see you in the next video.